Welcome to the Upside Journal podcast. In 2026, domestic venture capital is struggling with extended exit timelines and dry powder gridlock. Yet, a sophisticated layer of cross-border diaspora business networks is quietly unlocking predictable, counter-cyclical returns in AI and climate tech. Today, we're breaking down the hidden alpha traditional funds are missing.
To deconstruct this shift, we're breaking today's explainer into 4 acts. First, the VC paradox of 2026. Then, Act 2 covers asymmetric information and verification. Act 3 is all about the climate tech supply chain edge. And finally, we'll map out the repeatable flywheel framework in Act 4.
All right, let's jump right into Act 1, the VC paradox of 2026.
You can literally feel the macroeconomic friction right now. I mean, for over a decade, legacy international banks have been aggressively de-risking. Because of skyrocketing compliance costs and these massive multi-jurisdictional AML fines, Tier 1 banks have just systematically pulled out of emerging markets. And honestly, this retreat has left a gaping infrastructural void in cross-border capital flows. Just look at the sheer scale of this contraction in the data. We're talking about a gridlock that is absolutely undeniable. Angola saw a massive 37.2% drop in foreign counterparties. Mauritius faced a 16% contraction, and South Africa dropped by over 10%. This isn't just some temporary market hiccup, right? This is a structural, fundamental abandonment of cross-border settlements by traditional institutions.
Exactly. And early attempts to patch this profound liquidity vacuum were just incredibly fragmented. We saw first-generation solutions pop up. Things like mobile money through M-Pesa Global, your traditional money transfer operators, and even early crypto rails like Stellar and the Lightning Network. Now sure, they solved speed and cost for isolated peer-to-peer transactions, but they completely failed to build the instantaneous multi-currency settlement infrastructure that institutional capital actually demands. They were built for single-leg retail remittances. They were never engineered to handle true cross-border institutional liquidity.
Which brings us to Act 2, asymmetric information and talent verification. Look, the era of the traditional remittance business model is completely over. Fee compression has basically driven transaction margins into the ground. If your platform is only competing on the cost of a single transaction, you're operating a dead-end economic model. The real pivot we're seeing is the move away from that transient send-and-forget interaction. Modern Diaspora financial infrastructure is a whole different beast. It establishes a persistent account and competes on the total financial relationship. Platforms like LemFi aren't just shifting money from point A to point B anymore. They're building these incredibly sticky multi-currency balances and creating repeat financial touchpoints. They've effectively transformed a commoditized transaction into a highly defensible financial ecosystem.
Right? And the absolute key here is how these next-generation platforms actually defend that ecosystem. They do it by digging a massive operational moat. True category-defining fintechs look at complex AML regulations and dynamic API-first banking integrations, and they don't see them as operational cost centers. They see them as insurmountable barriers to entry. By mastering this multi-jurisdictional compliance and executing really strategic regulatory arbitrage, they're verifying elite talent and locking in an asymmetric information advantage that legacy competitors literally cannot replicate.
Moving right along to Act 3, the climate tech supply chain edge.
To really understand how this infrastructure funnels capital so seamlessly into capital-intensive sectors like climate tech, we have to look under the hood and deconstruct the modern cross-border financial stack. It essentially breaks down into 5 critical layers. Layer 1, identity verification, utilizing local eKYC integrations. 2, compliance and licensing, dynamically reconciling all those complex requirements across different jurisdictions. 3, FX and settlement. 4, multi-currency accounts. And 5, distribution. You can't just rent these components and expect to scale. These are the absolute core infrastructural prerequisites you need for a fully operational multi-currency platform that can actually hold billions in assets.
Let's zoom in on Layer 3 for a second, because this is where those data-driven economic mechanics really start to shine. FX and settlement. We're talking about the capacity to hold institutional liquidity in market, dynamically route foreign exchange, and just entirely bypass those expensive, sluggish legacy correspondent banks. When you own this specific settlement path, you directly strip out intermediary friction. It's the absolute linchpin for unlocking real institutional liquidity management across borders.
And that takes us to Act 4, the repeatable flywheel framework.
So how do sophisticated operators actually scale these platforms and secure those incredibly hard-to-get Tier 1 regulatory licenses around the world? They run a very specific, repeatable flywheel. It's all about compounding user trust through flawless technical execution, establishing those persistent multi-currency accounts, and locking in cross-border network effects. The companies successfully scaling this model use this exact framework to aggressively expand their license corridors. They aren't just moving money. They are building a sticky, year-round financial home for the global diaspora, which generates fundamentally different and far superior unit economics than your basic remittance players.
Let's put some hard numbers to this narrative. In 2024, fintech grabbed a staggering 47% of all startup investments in key emerging markets. That's over $1 billion. This isn't just speculative theory. It is hard proof of exactly where smart institutional capital is flowing right now. This Diaspora infrastructure layer is pulling in massive venture backing precisely because the economic mechanics are incredibly robust, predictable, and they offer those counter-cyclical returns that are totally missing in domestic markets today.
Exactly. And the broader macroeconomic application here is massive. Once this diaspora financial infrastructure solves the underlying compliance and liquidity bottlenecks, that capital doesn't just sit idle. We're talking about billions in previously fragmented remittances that can now be effectively structured. Nations like Nigeria and Ghana are already leveraging these tech-based platforms to route capital directly into sovereign diaspora bonds, direct foreign investments, and high-yield critical sectors. It is literally reshaping the global capital supply chain from the ground up.
Capital has become highly commoditized, but the infrastructure to execute high-trust, cross-border deal flow is rare. To get ahead of these macro signals and access our premium investor network, subscribe to the Upside Journal and join our membership communities. See you in the next Daily Drop.